Vanguard is now predicting bonds to give you similar returns to stocks with a third of the risk. Wow. Pablo does not want to hear that. Pablo's a stock guy. Pablo, your breath really stinks, buddy. Oh. So let's take a look at this. This is for 10 years, amigos. 10 years. I just got this today in my email box. As of April 19, 2023, but I literally just got it. Check this out. Vanguard's outlook, our 10 years annualized nominal return. That's before inflation. All right. They're based on the 31 December 2022 Vanguard Capital Models market, which is what I use. I don't change it mid-year, just FYI. I do change it at the end of the year. But anyway, check this out. Here's U.S. equities. Return projections about 5.4%. With a median volatility of 17.2. That's what we're going to call risk. Now, that's not truly risk, Josh. All right, everyone looks at volatility as risk. No one cares about the upside. They do care about the downside. What are you boys doing? So anyway, so what this means, we times this by 3. So that's a 51% standard deviation. 3 standard deviations, 51% on the downside. Whoa. Hold on a second. Dogs are chasing something. Hold on a second. What you do is you take this number times by 3 and then subtract or minus by half, this right here, 5. We'll just say 5% for simplicity. All right, so that gives us 51 minus 5. On any given year, Vanguard would think you could be down 46% in stocks. And you could be up 56%. I mean, you got to look at both sides. That's some serious volatility. That's worse than 2008, amigos. And 2008 was the worst year we've ever had. 1931 was worse. No, not when you factor inflation. Look at that. Now, if we come down to fixed income, here's our aggregate bonds, 4.5%. So 5.5, 4.5. Aggregate volatility in bonds, 5.5. Aggregate volatility in stocks, 17. So I mean, what? You think about it, why would... Look, I've done videos where I don't buy bonds. That was a different era. And some guy says, Josh, you're not very consistent. And I banned him because I said, dude, I change my consistency when the markets change. You should never do that. I hate that crap. You should never change when you have new data. Are you nuts? It's insane. I was just talking to this guy today. He's going to hang up his boots. He's 92.8. I said, dude, you got to back off that the risk, dude. You're killing me here. Killing me, baby. You know what I'm saying? And we backed off the risk and said, you're still doing fine. Why? If you don't need to, why play the game if you don't need to? I'm not saying go all stock, all bonds. I'm just saying if the rate of return projection for stocks has gone down, the rate of projection for bonds has gone up, and we'll just say stocks just a little bit above that, but bonds have significant less downside risk. Well, I guess that was stocks. Bonds have significant less downside risk, and stocks are all over the place. And you just retired, the easiest way to avoid sequence of return risk is to go more heavy in bonds. That's just a fact. He goes, oh, okay, gotcha. I was like, man, you're killing me. Make me nervous. And he can see by now he's too nervous. I said, I get it. All right, so let's take look, inflation, 2.5. All right, so we got aggregate bonds, 4.5, 2.5 from inflation, you get net at 2%. That makes sense to me. And you get aggregate stocks, 5.5, net of inflation, 2.5, 3 of aggregate stocks. So 2.5 net of inflation for bonds, 3 for stocks. Was it 2.5? What was it? 2 for stocks. No, 2 for 4.5. 2.5. Yeah. 2 for bonds, 5.5. 3 for stocks. So pretty doggone close. Real returns for stocks and bonds, man. I mean, I don't know what to tell you. Let's see what they... housing, I don't care about that. Vanguard forecast. We expect a housing rebound in 24, 25. All right. I think they have emerging markets on here. Yeah, look at that. They got emerging markets with 26.3% volatility. Look at REITs. It's about 6, roughly 6, 5.5 to 6%. With, I mean, small caps, U.S. growth. Yeah, they're still big on value, as am I. 100%, man. U.S. Treasury tips, high yield corporate bonds. These are corporate bonds. So corporate bonds a little bit more than the aggregate bonds. Anyway. I mean, I don't know what to tell you, man. We expect a housing rebound. Euro area, who cares about the euro? They're done. They're dead in the water. China, China is now the second largest country in the world. India's first. Emerging markets. We recently raised our expectations for emerging market. I don't get it, but whatever, man. Anyway, it's right there. Vanguard predicts bonds to give you stock-like returns with a third of the risk. Take that. I can't say take it to the bank, but you heard it here first, dude. If you're not adjusting your portfolio accordingly, I think you're making a mistake. But that's on you. That's okay. Love to hear your thoughts. We'll see you.